Hello, everyone. Thank you for joining our webinar, Prioritizing Personal Growth and Prosperity. We're going to go ahead and kick off, but before we do so, just a couple quick reminders. Today, questions are welcome throughout the presentation. You may submit one using the Q&A and chat function you will find on the bottom of your screen. We're working to answer questions throughout the presentation that we've received in advance. Any questions we get during, we're going to save until the end. If we run out of time or we can't get to them, we're going to go ahead and just email you directly. So please send those in. We look forward to having an engaging presentation, and we love hearing from you. Additionally, the presentation today is recorded. The slides will be made available. Everything will be emailed directly to you. Additionally, we will have everything hosted on raymond.com for your convenience. With that, we're going to go ahead and get started. We have a great panel of speakers for you today. Kicking off with Anthony Licavoli in our Advisory and Tax Department, Ryan Sullivan, our Managing Director of Wealth Management, and Greg Light, our Principal of Business Valuation. With that, we're going to go ahead and turn it over to you, Tony.
All right, thank you, Sam. So before we get into our main topics today, we thought it makes sense to spend a few minutes sort of setting the table on some items to consider with the upcoming election. So I'm going to spend the next 10 minutes or so comparing the two presidential candidates' tax plans. And well, I say comparing, really the focus will be on the former vice president's proposals that are on the right-hand side of that slide. So very quickly on the left-hand side, looking at the President Trump proposals, really not much to talk about here because these items aren't really part of an overall comprehensive plan. They're just things that have been brought up by President Trump over the past couple of years. But I do want to mention the first bullet point there, making permanent the 2017 Tax Cuts and Jobs Act provisions. So many of the individual tax provisions that were included in this bill actually do expire or they sunset by 2026. So that includes things like, if you're looking at the individual side, the individual rate cuts, the increase in the standard deduction, as well as the qualified business income deduction as well. That also does expire. So without getting into any of the reasons why they were set up to expire, I think the president, as well as most, if not all Republicans in Congress, want to make sure, or they want to see these tax cuts get made permanent, or at the very least, I think they want to make sure they get extended past that 2025 date. Last item, briefly, just want to talk about, President Trump's spoken a lot about reducing payroll taxes in some form, and he even had the executive order that came out where employees could defer paying a portion of their payroll taxes through the end of the year. Now, most businesses didn't end up adopting the deferral for numerous reasons, but I think if the president is reelected, I think this could be an area of tax he does focus on. However, with that being said, I don't think there's much support by either party in Congress right now to change anything with payroll taxes. So moving over to the right-hand side of our slide and the former vice president's proposals. Now, this obviously, the former vice president is taking on a much different approach to tax policy than President Trump. And really, there's probably no other way to state this, but President Trump's plans is, about tax cuts. The former vice president's plans are about raising taxes for a certain group of taxpayers, while then offering certain credits and incentives for other groups of taxpayers. And for this presentation, I want to focus on 3 bullet points here that I think will tie in nicely to what Greg and Ryan will be discussing. So that first bullet point on there, increasing your top tax rate from 37% to 39.6%. Now, this would be only for earners making over $400,000 a year. And this rate, the 39.6%, was actually the top rate under the Obama, or for part of the Obama Biden administration. Now, the $400,000 is a key number. It's sort of the line in the sand that the Biden campaign has set, where he has basically promised not to raise taxes on anyone making under that income threshold. And this number, I think most people are probably surprised to hear this, but the 400K is just about, depending on how you calculate it, it's just about where that top 1% of earners starts to phase in. So it's probably no coincidence why he picked that number. Now, the second bullet point I want to talk about are the qualified dividends and capital gains rates and making them taxed at ordinary income rates. So this would only be for taxpayers earning more than $1 million. Well, at least according to the proposal, it would only be for that. So it's not that $400,000 threshold. It's a much higher threshold, being the $1 million. So that would effectively tax, for someone making over $1 million, your dividends and your capital gains at 39.6%. So really, that could impact quite a few areas because currently our top capital gains rate, ignoring any additional taxes, the top rate is 20%. So you're potentially looking at doubling that tax rate on those specific items. So if you're looking at, let's say, a closely held corporation that does pay out dividends on a regular basis, you're looking at an effective tax rate up to 57% under this Biden proposal. So with a rate that high, if for people in corporate business structures, they'd obviously be rethinking that current business structure to see if there's something more advantageous as far as tax rates go. And then also, as you increase capital gains rates, you de-incentivize people to actually create capital gains, so they tend to hold on to investments longer as the rates on capital gains goes up. And then the last bullet point, is the second from last one on there actually that we'll talk about today, is that potential estate tax change. And I put potential on here because I think this is one of the areas that aren't as clear as some of the former vice president's other proposed policies, but I think it's going to be very important to the discussion that Ryan and Greg are going to have after this. So, one thing that's been talked about is reducing that overall gift or estate tax exemption back to the old levels. And the exemption, it's basically the amount that you can pass on tax-free to your heirs or to that next generation. So currently it's about $23 million if you're a married couple. So that's $23 million of wealth that you can pass on to the next generation free of any gift or estate tax. So under a Biden proposal, that amount could be significantly reduced. But the other item on there, and I think the more interesting item, is eliminating the step up in basis at death. So when a taxpayer passes away, currently their heirs would receive what's known as a step up in basis. So the basis in the assets that they inherit would be the fair market value, and that would be regardless whether or not the estate or whether or not that estate is subject to any tax or not. You still get that step up to fair market value. So if this goes away, a couple of potential outcomes. The next generation would either inherit that historic lower basis and then recognize the gain when they actually sell the asset, or all unrealized gains would be taxed upon a taxpayer's death. So your estate could be forced to actually sell capital assets in order to pay any potential tax liability from those unrealized gains. And I think this would be this is a pretty significant item because it's a significant change in the way our tax policy has been, where generally we like to wait until a realized event happens, like you actually selling some stock, before taxing you. And this is basically in order to avoid what we just discussed, is those forced sales to cover any potential tax liabilities. So a bunch of other stuff to talk about, but for this presentation, I think that sort of sets the table for what Brian and Greg are going to get into. But if you are interested in hearing more, I do invite you to attend our next presentation on the 29th. We'll be getting into a little bit more detail on these provisions, as well as some other business areas to consider as a result of COVID. So with that, I'm going to now turn it over to Ryan, who's going to discuss again what to be thinking about in terms of wealth planning for the future, which based on what we just went over is especially important right now. So Ryan?
Thanks, Tony. Clearly, and that's one of the reasons why I wanted to kick off with the parallels comparing the current administration versus former Vice President Biden's proposed changes. It's really creating a backdrop for planning right now and planning considerations, in addition to a lot of the activity, uncertainty, and events of 2020. This is just one more piece to consider as we come to the year end. So with that said, and really today for my focus, it's going to be to take a step back and talk about planning, goals, objectives, really identifying, has anything changed in your family's financial plan? And if so, how are we approaching that? In addition, we'll touch on some considerations, regardless of if there have been any changes to your financial plan. Some areas we want to look into or consider as we approach the end of the year for planning purposes. And again, this time as we approach October 15th, this is usually the time where you start to have those conversations with your advisors to identify any opportunities. So first of all, in a question that just curious, we found, it's different for everybody, of course, but this year, so much has occurred, everybody's had their own experiences. Have you noticed any long-term financial goals changing as a result of 2020? And again, whatever that means to you, right? And we've noticed for some folks, nothing's changed. For some folks, everything has changed. We'd just be curious where it sits for you. Yes, no, or not sure at this point. Well, excellent. Well, it looks like we've got really the higher percentage leaning towards yes. And again, that's all relative to what that means to you. So we'll circle back on the results of the polls a little later today. But moving on to really what does that mean? Goals and objectives. And so this might be more financial, traditional goals like retirement, saving for college, and those other types of real linear financial goals, but it might be something bigger than that, life goals. And I think this year, more than most, we've identified for most folks, they've really had these questions that they've considered, they've discussed. What does it mean? What do they want to accomplish today and into the future? And so the question typically is, then, have you really taken the time to step back and discuss how have the events of 2020 impacted these goals? So, are you just, does retirement mean, I know for us meeting with clients, a lot of changes that have occurred was kind of that definition of retirement. We noticed a trend for more and more folks who it's a different mindset as a goal for most. And so we've started to see the framework of the traditional retirement where you work for X number of years and then you stop working and you draw off your retirement and, for the final 10, 15, 20 years of your life. The attractiveness of that lifestyle has really changed. We're starting to see a generation of folks. It's not about, stopping work in a professional sense. It's about making changes and doing something else, doing something different. But this year seems to have really ramped up the speed with which we're having those conversations and really changing the focus of long-term financial goals, different from what we've seen traditionally over the years. So as you're starting to get in, then you identify what are those changes or what means less to you today than it meant to you 6, 7, 8 months ago. How does that impact your planning, right? Do you have new priorities? And again, we've seen this for folks who have recently retired, for those who have kids or grandkids, whatever the circumstance is for you, we've started to see a heightened sense of digging into what is the top priority for me and for my family versus what it may have been a year ago. Not to say that that's the situation for everybody, but we definitely have seen a trend line, which we think is a hard line trend of prioritizing in a different way. Now, it could be the moment, it could be the all the uncertainty we've faced this year. and that might change. But as you start to dig in and consider new priorities, how does that impact your planning? I mean, when you think about long-term plans, you're really identifying how to allocate resources today for future use. And if you're shifting the priorities around or changing your goals entirely, what does that mean for the path you were on? And does that result in a shift to how you allocate those resources today? So a great place to start, once you've identified, either, a couple of scenarios. One, no changes to our goals. Then the other extreme would be wholesale changes to our goals, and then someplace in the middle. Once you've identified and really painted those pictures of what your current goals are going forward, a great place to start, and a lot of the conversations we've been having for most households, is let's just get a better picture of your current financial position. And although this might seem pretty standard, what we have found is it means this is one area where we have noticed a pretty consistent change for most, is your sense of security in the short term. So that might mean as you're looking at your current financial position, we usually break that down into assets, liabilities, and income as really the three key areas. A particular area of focus has been cash reserve. So do you have adequate cash reserve? And again, we're back in March and in April, where there was, generally speaking, more uncertainty than today. We found that the conversation around having cash on hand to navigate through an uncertain time, be it investment market volatility, economic volatility, employment volatility, whatever that may be for you, cash on hand seems to help allow you to weather those storms. And so historically, we might say 3 to 6 months worth of cash on hand, three to 6 months worth of expenses to have in a adequate cash reserve. We've started to expand that. And for those who are business owners, who are self-employed, historically, we like more set aside. And now as we look ahead, especially with an election ahead, having, again, an enhanced cash reserve. So rather than 3 to 6 months, maybe it's 12 to 18. But again, really valuing that cash on hand to navigate periods of uncertainty. In addition, as Tony referenced, there's going to be the potential for tax changes. So as we're preparing for getting a better sense for what may lie ahead, really let's remind ourselves, based on your current assets, how are those going to be taxed today? How are they currently taxed, and how are they going to be taxed tomorrow? So we can be prepared to have a really meaningful planning discussion about how to shift if there are changes to the tax code. And having those conversations today rather than waiting is generally a good idea. So you can be prepared, feel educated and reminded of your current situation, and then have really actionable discussion going forward. In addition, liabilities, we're in a very low interest rate environment. So generally speaking, across the board, if you should reevaluate any debt you may have, there may be an opportunity to refinance and take advantage of these low interest rates, in addition to having some opportunity to impact your estate planning, which we'll touch on shortly. Next would be income. And this is, across the board, we have some relationships where they're having a great year from an income standpoint, others where their income completely shut off, and they've been trying to navigate a period with uncertainty surrounding their employment income or business income. And this is one that's clearly unique to every situation, but really taking a step back and getting a sense for, and comparing that to what you have for cash on hand, and how comfortable are you with your current income and your near term, looking again over the next 12 to 18 months, your near term income. And if you're feeling comfortable, then yeah, maybe the need for cash on hand is less. If there is some uncertainty ahead, let's plan for that and make sure you're doing what you can to protect yourself, so that if there is a change in your income, that you can, again, be in position to make the best long-term financial decisions for you. So next polling question: when did you last review your personal financial plan? And again, this one is different for everybody. I know for some folks this is an every 3-year process. For others, they like to do it every year, and for others, they don't have a financial plan at all. But we're always curious to get a sense for, especially in this environment, when was the last time you did review your financial plan? So it looks like the early trend here in the polling results is we've got roughly the majority saying earlier this year. So, and for most folks, it was a result of kind of a crash course, and we got to dig in the spring to assess how is this environment impacting us long term. Excellent. So yeah, 63% of the audience. Okay, next, as we start to get past the very short term, one process and structure that we found to be productive for most as they start to prioritize resources long term is how you think of the assets you have on hand. And a productive approach we have found is to really think in terms of having, thinking in terms of buckets of resources or buckets of assets set aside for different periods of time. So again, if you think about that short term being less than 2 years, then there's that intermediate term, 2 to 5 years, then 5 to 10 and 10 years and beyond. As you start to prioritize, especially when there's investment market volatility or economic uncertainty, it helps you manage the emotional side of seeing investment assets going up and down in value. If you can remind yourself that you don't need to touch those resources for at least 5 to 10 years plus, versus those assets that you're going to need in the next year or two. So if you can prioritize based on the time period, that seems to be a way to navigate through periods of uncertainty and volatility. Once you do that, you can start to identify, hey, do I have too much in the short-term bucket? Maybe I have too much in the long-term bucket or the intermediate term, and then you can shift between how you consider the use of these resources to make sure that you're best prepared for, again, periods of uncertainty and long-term planning. And then also, when you think of that, short-term buckets might be primarily comprised of cash, money market funds, or shorter-term investments. Long-term buckets might be more focused on retirement accounts, trust accounts, those types of positions. Let's reassess, does it still make the most sense to hold those different types of assets in these various buckets based on your time horizon? Now, as we approach the year end, so when we have that baseline for, really just taking a step back and reassessing your current financial plan, making sure you're taking care of for the short term, we do have a year end coming up as we look at, we're October 13th today. We're closing in on the year end with the potential for some tax code changes on the horizon here. A great time to have those conversations with your advisors is now. So what I would suggest is you start to look ahead over the next couple of months. Make sure you're in position and you've got time scheduled with your tax professional as well as your other advisors to discuss tax planning. And again, we might not know today what the current tax code ahead is going to look like, but at least you can do is prepare for what the election results may be. And then once we know those results, you can start to narrow down what we know and then identify any opportunities to act before year end based on the potential for changes in tax planning. Market volatility would be next. Of course, we had, in the spring, the conversation was really around harvesting losses, really taking, selling and generating losses that can be used to offset future gains. But then markets have come back dramatically in some asset classes. And so you might be sitting on still some unrealized losses, so the question might be, do you want to take those to realize them now and use them against future gains? Or are you sitting on unrealized gains now? Would it make sense to realize those this year from the standpoint of anticipating the tax code may change and not in your favor in the long run for long-term capital gains rates? But again, take advantage of the market volatility rather than just ride it out. There are tax planning strategies you can implement. And then of course, charitable planning. We'll touch on that in a little more detail here shortly. So year-end planning, as we get in, so I'd really categorize this as, in addition to the above topics, estate planning and charitable planning. So we had, of course, the CARES Act that was implemented earlier this year as a result of the pandemic that implemented some short-term kind of temporary changes to charitable planning. And then also we had a shift with the Secure Act at the end of 2019 that did impact for many folks how they look at long-term estate planning. So as Tony referenced, there are, the current environment might be a little more hospitable to passing on more assets tax-free relative to what has been proposed, potentially depending on the outcome of the election. So a good time to start digging in would be now and start taking a look at, how has the current environment and the anticipated potential future environment, how does that impact your estate planning? If you haven't done that in a couple of years, I would suggest, given the Secure Act alone, it's probably worth considering. Some of the highlights of the Secure Act worth noting would be the elimination of what's called a stretch IRA strategy, which allows you to transfer IRA assets to your heirs, non-spousal beneficiaries, and allowing them to stretch out those distributions over a long period of time. What has changed is those beneficiaries are now going to be required to take those distributions out within 10 years of inheriting them. So prior, you might be able to stretch those out over decades. Now, non-spousal beneficiaries are going to be required to distribute those and pay taxes on them over a much shorter period of time. So as you think of planning ahead, and you used to think of those IRA assets as maybe friendly to transitioning to the next generation, you might want to take another step and dig in a little deeper to forecast what that may mean to you. Additionally, as you think about estate planning, we're in a low interest rate environment, so many estate plans are driven by interest rates and gifting strategies that impact and are impacted by interest rates. We're in a historically low interest rate environment. So again, I would suggest taking a look at how that has impacted your estate plan strategies. Additionally, you may still have depressed assets that may make sense to structure either for gifting, charitable donations, or estate planning today versus the future ahead. And then of course, the overall estate planning tax code. So it might not be between now and the year end, but getting prepared. And then as we know more about the future tax code, how are you being proactive to address that? And then finally, again, charitable planning. As we get to the end of the year, this is a topic that does come up often. But right now, as a result of the CARES Act, there are a couple of easy opportunities to support organizations you care about that may not be available after year end. One would be for those of you that do itemize on your taxes. For cash donations, you were limited to 60% of your adjusted gross income as deductible. Going forward, again, if you itemize for the rest of the year, cash donations, the limit has been increased to 100% of your adjusted gross income. For corporate giving, that number has gone from 10% of adjusted gross income to 25%, again, for corporate giving. So great opportunities to support organizations you care about. And then for those that don't itemize, which again, it's a growing segment of the population, you still get this temporary opportunity to donate up to $300 and get what would really be the equivalent of an above the line deduction without having to itemize. So again, keep in mind as you're looking to support organizations that you care about that are charitable, there are a couple of opportunities that are temporary to this year to allow you to get that enhanced benefit from a tax planning standpoint. And really, it's a unique moment. So to consider those, over the next couple of months, and make sure you have time scheduled with your advisors to walk through these opportunities and how they may impact you.
Ryan, if I could just chime in there real quick.
Sure.
Perfect timing as it goes to my slide, but anyone out there that is thinking about doing any gifting of shares in businesses or anything like that, let me speak on behalf of the whole valuation profession and say, please get it to us sooner rather than later, because we all want to have a Thanksgiving and Christmas holiday with our families, and the volume of stuff that is coming in right now is absolute insanity. And what that's going to lead to is either slower turnaround times or higher prices for everybody. So this is definitely one where it's a first in, first out, and will help everybody to try to have a reasonable end of the year. So anything you can do to help us out, if you have any gifting or valuation work that has to be done coming up here soon, sooner the better, 100%.
Yeah, and I think, Greg, to represent that effort for you and your team, I would suggest rather than wait for, we've heard plenty of it's either wait for you get through October or wait for the election. Don't wait. Yeah, get scheduled, get that process moving forward, and then we'll know more later. But yes, if you want a better outcome, definitely start that process sooner. With that said, I'll hand it off to Greg, who's going to tackle valuation and some related topics.
Thanks, Ryan. So Greg Light here, principal in Raymond's valuation group. I work in our Troy office, but every day is a little bit different now. I do a lot of presenting, and I really like doing it in person, where I can walk around the room and see people's faces and make sure things are being understood. Obviously, I can't do that here today. So if you have any questions as we're going through this, please put it in the Q&A and I'll address it as we're going through it. First one of these I did on Zoom was a few weeks ago, and I was explaining the same thing and how I talk with my hands and stuff like that. And as I did it, I knocked over a 32-ounce glass of water, and it shattered all over, got my dog all wet. So we've made it through the first 30 seconds here with no glass breaking, so we're doing good here. Topics of discussion for today, we're going to be talking about working in versus working on the business and what that means. some valuation specifics, market volatility, valuation trends, how private equity impacts valuation, what the overall market has looked like, then give a little conclusion, go over some of the stuff, bring it all together, then a couple of minutes for questions for any of the presenters at the end here. So working in the business versus working on the business. What does that mean? That kind of sounds like the same thing. The way I explain it to people is pretend you're riding a bike on a very, very long race. Working, and there's something wrong with the bike. You've got a flat tire or your chain's broken or something. Working in the business would be continuing to just struggle along on that bike that's not running at its optimal potential. Working on the business would be having the foresight to stop and fix what was wrong, knowing that it was going to lead to better efficiency in the long run, and you're going to accomplish your goal much quicker, even though you have to stop and and pause and take a break and feel like you're not getting anywhere for a minute. So that same idea can be applied to business ownership and business management. We see a lot of people working in their business. They're there grinding it out every day, focusing on the bottom line. They do every single thing that you can think about at that business, from collecting on receivables to sales to fixing a machine in the shop. They're truly a jack of all trades. They don't delegate anything. That responsibility never changes. The roles and titles aren't adhered to. Prioritizing only happens by urgency. It's like the most stressful situation you can possibly imagine. That's working in the business. The title of this webinar today is Prioritizing Personal Growth. To do that when it comes to from an evaluation perspective and a business management perspective, is kind of flipping the script on this. Working on the business. How do you grow as a business owner to try to make your business sellable, more successful, more profitable, leave a legacy? Think about a succession plan and an exit strategy. Be able to actually take a vacation. I know a lot of business owners, when I say, when's the last time you had a 2-week vacation? They just say, yeah, right. That's what working on the business should be able to do. It's not just always about exiting the business. Sometimes it's about identifying those people that can handle additional responsibility, making it so, there is the possibility of going to, the Caribbean for a month in the winter if you really wanted to, because that the people that are going to handle things in your absence are going to be able to do it. It's the number one thing that we advise clients to do for every possible outcome, whether it's a transition to family members, an outright sale, transition to employees, or just continuing to operate the business, is thinking about how they can improve and work on the business as opposed to just working in it. Sam, next slide, please. So to what extent have you worked on a succession plan? You can see the choices there. Don't be shy. Nobody's perfect at this stuff. It's just the process is important, and I think you learn a lot through the process. Throughout the process, I'm seeing some results come in, and looks like 60+% are either fully prepared or have started the process, which is fantastic. That's rare. So it must be a pretty dialed in group that we've got here today. So how are businesses valued? Excuse me. When we think about the value drivers, it's always cash flow and risk and cash flow, both being equally important. That's really what we're trying to evaluate when we're looking at the value of a business, is what sort of cash flow can the company be expected to generate in the future, and what is the risk associated with continuing to generate that cash flow. Some adjustments we have to make to get to that level of expected future cash flow are adding back personal expenses. Almost every small business owner that we work with has some level, either large or small, of personal expenses running through the business, whether it be personal auto, country club dues, meals and entertainment, travel, a non-working family member that gets a paycheck, cell phones, all that kind of stuff. So what we do is we add back those expenses to try to help us understand what the cash flow would look like to an actual buyer of the business if they did not have all that personal expense running through. Same thing with non-recurring items. You know, you have a new website built, costs $30,000. That's not something that's going to occur every year. So we don't want to use that when we look at what the future cash flow of the business might look like. So we're going to add that back, try to get to a position of understanding ongoing future cash flow that we can actually use in these approaches up top. Income approach looks at the future income generated by the business, a couple different forms of it. One can be based on like a single period that's going to be typical in the future. Another version, we can use what's called the discounted cash flow method, where we actually have the ability to show, like, I don't know, 3 to 5 years worth of changes in margins or abnormal growth rates or one-time capital expenditures, things like that. Market approach, that would look at transactions of similar businesses and what sort of multiples they were sold for, and then using those multiples to compare to the business we're valuing. And then an asset-based approach, which we do not use all that frequently because it really ignores the intangible value of a business. But it's the concept of what is owned by a business less what is owed by the business. Really relevant for, you know, a real estate company or an asset holding company, something along those lines. Every one of these approaches, though, takes into account that cash flow and risk in some form or another. Every question we ask, you can see all the things on that last slide that we were talking about. Those are all going in some fashion to help us understand how much cash flow there is, how much risk there is, maximizing that cash flow, minimizing the risk so that you get full value out of what in a lot of situations was a business that took a lifetime to build and nurture. Next slide, please. So why is this a unique time? Well, 2020, strangest year of my life, that's for sure. And everybody I've talked to has pretty much said the same. That's what volatility has looked like in share prices over the last 5 years. 2020, the highest on record for sure. You can see back in that March, April timeframe how it just absolutely skyrocketed, more than double what it had ever been in the last 5 years. What that's doing is causing uncertainty for business owners, volatility in prices. It increases the, we have a concept called a discount for lack of marketability, meaning how much less a business is worth that's privately held versus publicly traded. And one of the main drivers of how much of a discount that is this market volatility, because it relates to, you know, how much could a price go down while you're waiting or trying to sell a business, or what's the cost of insurance relating to protecting the value of your investment. And anytime there's volatility, prices for insurance or options or anything like that go up. So this is what's driving a lot of the craziness and insanity that we're seeing right now, where people are trying to make that decision. Do I stay? Do I get out? If I get out, is right now the right time? What's it going to do to pricing? All sorts of things like that. Next slide, thanks. So here's some valuation trends that we've, we keep our eye on over time. The dashed line is a trailing 3-quarter average. So you're not going to see as much movement in that one, but it's more of a longer term view. So you can see how multiples over time have definitely trended upward. It's going to be really interesting to see what that looks like when the Q3 data comes out. I imagine it will go down. But what I really wanted to highlight out of this is whenever you talk to somebody that has sold a business, it seems like all you ever hear about is the person who sold their business for 9 times EBITDA, 12 times EBITDA, these eye-popping numbers. Nobody ever talks about when they sold for 4.5 or 5 times EBITDA, because it's normal, it's average, it's typical. And when those people say they sold their business, they say, yeah, I sold my business. I got a good price for it. They don't tell you what multiple it is. And that's fine. But the purpose of this chart is to help people understand that those eye-popping multiples you see sometimes are not reality. They happen every once in a while, but they are far from the average or the norm. I'm working on valuing a business right now that we'll probably end up selling at about 2.7 times EBITDA, just because of the industry they're in, the size they're in. So for every really high multiple there is, there's always a low one too. So this is how things have been trending over time. Multiples have increased. You can see back in 2015, 2016, we'd been between 3.5 and 4 on average, whereas now we're 4.25 to 5 on average. A lot of that was due to the Tax Cuts and Jobs Act changes, which led to a lot more cash flow actually dropping to the bottom line on an after-tax basis. So that increased multiples. So this just shows where the market really is right now, and where it's going. Who knows? All I can say is 2020. Next slide, please. So what's impacting some of this? It's a pretty good seller's market for businesses right now. Why is that? Private equity funds out there have what they call dry powder, which is capital that they've raised from investors that they have not yet used to purchase a company or invest in anything. $1.45 trillion at the end of 2019. What that's doing is leading to private equity chasing a lot of businesses that are for sale, but usually it's a little bit bigger businesses. It's the 5 to 10 to 20 million in EBITDA. So what happens is it really drives up the multiples on those businesses, because that's the size where they start being relevant and usable from a private equity perspective. And those are the ones that might go for 8 or 10 times EBITDA if there's a bidding war or something like that. But that is such a small amount of the businesses that are sold in the United States every year. For every $20 million EBITDA company that is bought or sold, there's probably 50 small businesses, Main Street type businesses that are bought or sold. So one of two things are going to happen. These private equity investors are going to start giving money back to their investors and say, hey, we couldn't deploy this capital. Or they're going to keep buying and buying and buying and raising multiples on those bigger companies. Who knows which way it's going to go, but I just don't really see this impacting smaller size businesses much, because it just doesn't make sense for a private equity firm to go and buy a convenience store on the corner of a street in Lansing. It's just they don't want to deal with it. Maybe if it's a portfolio of 50 gas stations, maybe they're doing it, but then you're up in that higher echelon of value and EBITDA that does get that high multiple. So just an idea of what the overall market has done. Absolute insanity. It just goes to show the fear that overtook things, and in my opinion, the irrational exuberance with recovery. I don't know how we're back at pre-pandemic levels when unemployment is where it is, and we're talking stimulus, and there's all this money that the government's spending to give, or to help out, which is probably going to cause inflation. But it just goes to show you how quickly things can change, how quickly your portfolio could have changed, and how quickly it may have recovered. A lot of what we were doing when we were valuing businesses, we were basing their valuation on a pre-pandemic level, and then making a COVID-19 adjustment where we would look at, okay, from 12/31/19 through today, or whatever day we were valuing it, what has the industry of public companies done in their industry? If we couldn't find good public companies in their industry, we might say, okay, what did the overall market do? I have a hard time right now telling a business owner that the value of their business is unchanged from 12/31/19 through today, because we see the hurt going on every day and the struggles that people are facing, trying to figure out PPP loan forgiveness, all these, all these things. So it's, in spite of how this chart might look, I always caution my clients to not be so dead set on the fact that their business may not have declined in value just because the overall market has stayed pretty much the same, in spite of the volatility over the 10 months preceding it. So another poll question, when was the last time you had a valuation performed if you are a business owner? All right, got some results coming in here. About half and half of people that have had one done versus who have not had one, and then the other half of the people it wasn't relevant for. So, okay, as they say, knowledge is power. So if you ever do need help with anything like that, doesn't have to be a big formal process or anything. We're happy to hop on a quick call with you, explain what value drivers might look like, how we would perform the valuation, so on and so forth. So little conclusion here of, what I've seen over the last year, most importantly, and, longer term, when we speak in general terms, a lot of people are scared straight from this. They were in this opinion of, oh, the good times are going to continue forever. It's easy to forget about 2008, 2009, because we had the longest sustained economic recovery in history. So people got caught up thinking that things are great, things are going to continue to be great. I have nothing to worry about. This pandemic has really showed a lot of people that it's the things you can't plan for or foresee that are going to jump up and nip you. And that's exactly what happened here. A lot of businesses that probably now wish they would have sold or could have sold in 2019 are out of business. I hate to be the one preaching fear, but it's important for people to think about, how much, how long they're willing to stick it out in the business, how long, how much capital they have to survive a downturn if there were no economic stimulus like there was. The next one on their runway, how long do they want to be in, still working in the business? A lot of people say, oh, I got another 2-3 years in me. Well, what if the economy and market had not recovered from April, May lows? That's a lot of people that would not be able to retire when all of a sudden their business is worth 50% of what it was 2 months prior. So keeping in mind that runway and knowing it's usually better to get out a little too early than a little bit too late. The next one, having your cake and eating it too. That's the idea of people thought they could continue to take the cash flow from the business for years on end and always assume they were going to be able to sell it for a high price and a high multiple. The good times are never going to go on forever. And usually when one of those things falls off a cliff, meaning cash flow, then the multiple and or price is going to fall off that same cliff as well. So if you want to get a high price for a business, you got to sell it to somebody when they're going to have the opportunity to earn some of that high cash flow as well. Business or a job, this is one that goes back to working in versus on the business. A lot of people think they own a business, but in reality, they just have a really high paying job because they cannot sell that business to anybody. They're wearing every hat you can think of in the business. They don't identify successors. They don't delegate. Nobody could come in there and buy the business. That means they don't have a business. They have a job, might be really, really good paying job, but that kind of gets back to the having their cake and eating it too. You can't assume that somebody's going to be willing to come in and buy a business from you when it would take 2 or 3 years to transition all of your knowledge and responsibilities to someone else. And last one, preserving wealth. That's just the moral of the story here is, the name of the title of the webinar is prioritizing personal growth. Part of that is finding ways to maximize the value of all the hard work you've put in, of your investment, and preserving that wealth that you built up over, it could be a whole lifetime or at least a generation, and, leaving it, leaving the the business world with more wealth than you came into it with, and having made it a better place. Crazy times right now, and just it I know it's a cliche, but failing to plan is planning to fail. So have a plan, make it a priority for yourself, your business, your employees, your family members, all that kind of stuff. Any questions that have popped in?
Yeah, Greg, thank you so much. Greg,
Yep.
Ryan, that was very helpful to kind of walk through that. Greg, quick question on the evaluation. So did you see, you had mentioned earlier about enjoying Thanksgiving with your family. Did you see throughout COVID that we had an uptick of valuations where people generally do them, but do you feel like there was more that came in throughout the year this year because it was such a hectic year that we just saw more people kind of understand where they're at, what this looks like, kind of put that emphasis on succession planning?
Not at first, that April or that March, April, May timeframe, we didn't have a whole lot to do because people were busy working in their business instead of on their business. They were triaging, and trying to survive and figure out the PPP loans and where they were going to have cash for payroll coming from. But after that got passed, or after people got past that and they were able to, maybe enjoy a little bit of the slower pace of life, it did give a lot of people the opportunity to start thinking about, okay, what does this mean? What's my next steps? And we have been absolutely slammed ever since then. So year over year, we're probably about where we were, but the second half of the year has been absolute insanity.
And Sam, I'd chime in on that. I would say an absolute consistency is probably midsummer. The conversations we're having with business owner clients where they were maybe prior to COVID, they were looking at a 5 to 7 year window where they wanted to be prepared to exit. We've had plenty of conversations now with those business owners who are starting to see in the very near term what they need to do to properly tool, not just for a pandemic, but frankly, a mobile remote workforce, and everything that comes with some of these forced changes that we're living through right now. And we've plenty of business owners that are just saying, look, I don't have the energy or the desire to retool this thing. I'd like to maybe move my time frame up, and let's figure out a way to get out sooner than 5 to 7 years. That conversation's happening. It might not result in the succession planning or valuation work this year, but I think you're going to see that continue to be an area of focus as again, many folks reprioritize what they want to do over the next 5 to 10 years plus.
Great. Well, thank you both for that. A lot of the other questions we actually answered throughout the presentation today. Quick reminder, Tony covered it earlier. We have another webinar coming up October 29th, talking about accounting, cash flow, tax strategies, kind of throughout the end of the year, what we've seen throughout COVID, what to consider. Make sure you register for that. Additionally, the presentation today, the recording, slides, all of that will be emailed directly to you. Greg, Ryan, Tony, thank you so much for your information today. We really appreciate it. On the screen, you can see contact information. If you have any questions following, feel free to reach out to our presenters today. Thank you all so much for joining us. We appreciate it, and have a wonderful Tuesday.
Thank you.
Thank you.